In July 2014, we published our new financial instrument standard, IFRS 9, and it covers 3 different aspects of accounting for financial instruments. Firstly, how they're classified and measured. Secondly, how impairment or expected credit losses are accounted for. And thirdly, hedge accounting. Now, the first 2 parts of IFRS 9, classification and measurement, and impairment, were very much our response to the financial crisis. So, for example, on classification and measurement, we've changed the requirements in IFRS so that when an entity's credit risk increases, they don't book gains in profit or loss as a result. On impairment, we moved from an incurred loss model to a more forward-looking expected credit loss model. Now, the third part of IFRS 9, hedge accounting, isn't really a direct response to the financial crisis, but what it does do is requires people to provide better information about their risk management activities, which helps inform the users of their financial statements. In IFRS 9, we changed the accounting for impairment of financial instruments from a so-called incurred loss impairment model to an expected loss impairment model. Now, this is a really important part of our response to the financial crisis, because during the financial crisis, people raised concerns that the accounting for impairment resulted in booking loan losses and loan loss allowances too little too late. So what IFRS 9 does in moving to an expected credit loss model is really 2 things. Firstly, right from when an entity lends money, it starts to account for its expected credit losses. It doesn't wait until an event happens before it does that. And secondly, when expected credit losses are measured, they are measured using all reasonable and supportable information that's available to the entity, which includes not just their historical loss experience and current information, but also their forward-looking expectations based on reasonable and supportable information. Now, during the financial crisis, people told us that there were circumstances when they expected losses to arise in the future, but they weren't able to take into account that forward-looking expectation. So IFRS 9 is very much designed to address that concern. The other part of the impairment model in IFRS 9, which is really almost as important as the measurement and recognition requirements, is the disclosures that come with it. So there's a lot more information provided to users of financial statements about the financial instruments that are showing credit risk that's what the entity would have expected when it lent money, and separately information about financial instruments that are performing worse than was anticipated by the company, and information about the sort of absolute credit quality of their financial instruments as at the reporting date. So the combination of the more forward-looking model and that richer set of information should enable people to much better understand the real credit loss expectations of reporting entities. So we published IFRS 9 some time ago now, back in July 2014, so over 18 months ago, and it's still only effective in 2018, so sometimes people think that seems like an awfully long time between when we finished our job and when people start to show the changes in their financial statements. But we made a very conscious decision allowing such a long lead time, and the reason for it is that we know that preparers, and particularly those in the banking and insurance industries, have got to make changes to their systems to put in place these new expected credit loss impairment requirements, which are a big change in accounting. So while it's been quiet for us for the last 18 months or so, for the preparers, they've been very busy involved in their implementation and planning processes and working with audit firms and prudential regulators to talk about the changes that they're putting in place to implement the new standard. Whenever we issue a new standard, particularly a major one, we're always interested in the implementation process that people are going through, and also whether any interpretation questions arise in implementation. So, as is always the case with the new standard, we've been involved in conferences and discussions and outreach activities, talking to people who are implementing IFRS 9, and particularly talking about the expected credit loss requirements, because they're such a big change in accounting. But what we did when we published IFRS 9 was, at the time we actually published, we announced that we were establishing an implementation group, a transition resource group as we call it, to help with the implementation of IFRS 9. And it was really because we knew that people were going to have to make big systems changes, and it was such a big change in mindset that we took this relatively unusual step. And what the transition resource group is and was is a group of experts in credit risk management who met in public to discuss questions that were submitted by people implementing IFRS 9 that we thought would help people understand the requirements of IFRS 9, give confirmation of what the requirements are, and also provide a forum where people listening could hear the types of approaches people in practice were taking to implement those requirements. So the ITG met 3 times in 2015 and covered a whole range of questions, which provided, I think, a lot of educational assistance for people, and we didn't actually identify any areas where we felt we needed to make changes to the standard itself, which was a good confirmation for us. Now, we don't plan at the moment to hold any more transition group meetings on impairment, but we do still have the group in place, and people can still submit questions if they have them through our website. So we stand ready, if you like, if people need help with the implementation process. So IFRS 9 sets out the expected credit loss requirements for financial instruments from a general purpose financial reporting perspective for entities that are applying IFRS. And that's separate to what the prudential regulators might require to be calculated for capital adequacy purposes. But we do have a very close relationship with the Basel Committee, and one thing that they have done is put in place some guidance on what they consider to be best practice for banks applying IFRS 9, what their expectations would be, particularly for internationally active banks, more sophisticated banks, when they're working out expected credit losses. And we often get asked whether we see that as a positive or not. And from our point of view, we see that as very much complementary to IFRS 9, so it really sets out their view on what's a good application of an expected credit loss model. The Enhanced Disclosure Task Force, which is a group that was established by the Financial Stability Board, have also done some work, and they've updated their recommendations on what would be good practice for disclosures in the context of an expected credit loss model. Again, that's not mandatory and it's not an IFRS requirement, but it's another set of information which is helpful for those applying IFRS 9 to look to as best practice, if you like, when they're thinking about what disclosures might help users of financial statements understand the expected credit loss requirements in IFRS 9. So in terms of looking forward, we've finished what we are going to publish on financial instruments for the moment in terms of IFRS 9, so there's a stable platform, if you like, for people implementing IFRS 9. Having said that, we're still interested in the implementation activities that people are undertaking, and if people did have extra questions, there's still the ability to submit them through our website. And as I said, the Transition Resource Group stands ready in case we need to use them. The other thing that's still happening on financial instruments is the work that our US counterparts, the Financial Accounting Standards Board, is undertaking. They recently published new requirements on classification and measurement, which importantly include own credit changes which are very similar to the ones that we've put into IFRS 9, again resulting in gains and losses not being recognised as a result of changes in an entity's own credit risk. And then we expect the FASB to publish a new impairment model shortly in the first half of 2016, which, like ours, is a move to a more forward-looking expected credit loss model with differences in detail to what's in IFRS 9, but a lot of commonalities, particularly in the information set that's used to measure expected credit losses.